Today, I'm going to teach you a tool that every self-employed borrower needs to know. Hey everybody, my name is Krista Lindstrom. I am here for Krista's Mortgage Minute, and today we're talking about self-employed borrowers. So there are 3 ways that a self-employed borrower can qualify for a mortgage. The first way that they qualify is by verifying all of their income with Canada Revenue. So essentially writing yourself a T4. That's easy to qualify for a mortgage, but it certainly isn't tax efficient. The number 2 way that a self-employed borrower qualifies for a mortgage is by something that we refer to as stated income. So stated income means that we take a look at your financial statements of your company and we look at how much the company is earning versus how much you are actually personally claiming. So is there retained earnings left at the end? If there are retained earnings, sometimes we can do an add back of that income and do something called a stated income mortgage, saying he could have claimed more, but they didn't. So that is what we refer to as self-employed stated income mortgage. And the number 3 way a self-employed borrower qualifies for a mortgage is what we refer to as the bank statement model. In the bank statement model, we take 6 months of your company bank statements and we take a look at all of the deposits. And then we take a look at your 5 largest expenses and deduct them. Then we annualize that over a year and come up with income. So the third way that we talked about there, the bank statement model, it is done with an alternative lender. So a lot of people think that maybe they shouldn't be using an alternative lender, or they think of themselves as less than for using an alternative lender. But let me tell you something. I'm a bit of a numbers geek when it comes to stuff like this, and I've ran the math. So I've ran the math with scenario number 1, where you're claiming all of your income with Canada Revenue. We are using an A lender, but you're paying a lot of income tax. And I've compared that to the third option, doing the bank statement model with an alternative lender. The interest rate is a little bit more expensive with an alternative lender, and there's often a lender fee included. But you are not paying Canada Revenue a whole lot of money in income tax because you're choosing to be tax efficient instead. And when you compare the two over the term of, let's say, a 3-year mortgage, the borrower who chooses the alternative lender and is tax efficient and not paying CRA a lot of income tax, but paying a little bit more in interest, is actually further ahead financially than the first borrower who's claiming all of their income with CRA. So that's what you need to know. There's more than one way to skin a cat when it comes to self-employed mortgages. If you know somebody who can use some mortgage advice, you know where to talk. Thanks so much for watching.